What's up, guys? In today's video, I'm going to be going over the strategy that has gotten me 5 funded accounts, that has gotten me payouts. I've been using it for a while now, and I'm not even going to waste too much of your time. I'm just going to go ahead, get straight to the point, and I'm going to make it as simple as I can. So starting off, the strategy is supply and demand. Now, I'm going to show you it this way first, and then I'll show you the actual way I use it. I'm going to go ahead and just draw a square right here, and then I'm going to go ahead and just draw a square right here as well. So let's think of this top rectangle as a level of supply, and we're going to think of this bottom one as a level of demand. So we have supply and we have demand right here. Now, for supply, you are going to sell from the levels of supply. So you're going to sell from up here, and then the levels of demand you are going to buy from. So demand, buy, supply, sell. Now, supply levels are going to look like this. Let's say with the way I trade, I use limit orders. So I'm already spotting levels of supply and demand in the markets, and that's what I'm aiming for it to hit. And then I'm going to take a sell or buy from whatever. So I would be looking to sell from a level of supply. So we're going to go ahead, go back to this, use the path, and you can see we're going to be coming up from a demand level, and we're going to be going all the way up to the supply level. We tap into the supply level, and then the market starts to go down. That's what would give us our winning trade right there. Hopefully winning trade. Obviously, it's not a 100% win rate. There's no setup out there, no strategy that has a 100% win rate. But you can see we would be selling from the supply level. Now it's complete opposite with demand. We would be looking to buy from the demand level. So we'd be coming off a level of supply. We'd be coming down here. We'd tap into that level of demand, and then we would just go up and hopefully take a W. But you could see right here, we would be buying from that level, and up here, we would be looking to sell. So I don't market through rectangles like I just showed you guys. A lot of people market through rectangles. I personally don't. I think the most accurate way is marking it with lines. So I'm going to go ahead and show you guys how I market with showing you guys real levels of supply and demand in the markets. Now, the key to my strategy is you need to have multiple time frames in confluence with each other. Okay, that's super important because the more time frames in confluence, the better. And I'm going to go ahead and just show you guys this, and I'm going to make it as simple as we can. Now, the first thing before I go ahead and mark it out is how do we find levels of supply and demand? So what you're going to want to be looking out for is a previous contract candle to a push, right? So I'm going to show you guys right here. Notice how we have this blue candle right here, and then we have this big drop down. This would be that previous contract candle to that push down. This would be a supply level. You would be looking to sell from here. If the market were to go back up, you'd be looking for it to tap into this level, and you'd look for sells. So we would be marking the bottom of the wick. You're going to want to mark the very bottom of the wick, candle, whatever, for a level of supply. Now, remember how I said multiple time frames in confluence? Notice how we are on the M15 time frame, and I went ahead and marked M15 right here because this is a level of supply on the M15 time frame. And I highly recommend, if you're going to do it the way I do it, to have templates right here. You can see I have all these time frames marked down, so I would highly recommend you do the same. It's going to make it way easier for you in the future. So that is on the M15 time frame. You can go right here and see on the H1, we have an H1 right here, and you would go ahead and do the same exact thing and mark H1 right there. All right, the recording just completely stopped. I don't know what happened, but you could see that was the M15 H1 marked out. Now we're on the M5 time frame, and you could see right here, we would look for that previous contrary candle, the same thing we do on every single other time frame. So you can see right here, we have the previous contrary candle to the push down. On the M5 time frame, we would go ahead, mark it right here, and then mark M5, and then there you go. Now we have 3 time frames in confluence with each other right there. Now it all depends on your stop loss sizes, because you want all these time frames to be within your stop loss. So let's just go ahead for an example. We'll put mine. We'll go ahead and do this. We'll do just 3 cons. And you can see that H1 would not be within my stop loss. So I would mainly just be looking at the M15, M5 here. Now the importance of having multiple timeframes in Confluence, multiple timeframes within your stop loss, is it's giving more opportunity for the trade to bounce off before it hits your stop loss, right? So let's take a look at this. Let's say we're going up. And obviously the best thing would be for it to tap right into here, go down, and to take profit, right? We would all love that. Or what might happen would be we're going up, we break past this level right here, we're still going up. Now it has one more opportunity for it to possibly reverse and go back into profit. Now, what is that level that it's most likely going to reverse off of? It's going to be a level of supply, that M5. So we're going to go up, tap right into that level, and hopefully we would see a rejection right off that M5, and then we could start going lower and lower right back into profit. Now, as you can see, that's 2 time frames right there. Imagine if there was maybe just one more right here. Let's just say it's an M1. You can imagine it just makes the odds higher that it's possibly going to reverse and get back into profit. It's making the probability higher for it to be a profitable trade. So just an example, you can see if we broke past this, now we have that for it to possibly react off of. And if it doesn't react off that fully, now it has that M5 for it to possibly react and get that move down. That is why multiple time frames are in Confluence, and that is that on a level of supply. Now it's the same thing when it comes to a level of demand. So let's go ahead and just take a look at this right now. See this previous contrary candle, then we had a pretty strong push up. This is on the M15 time frame. So you would go ahead and mark the top of the wick, put M15. Now let's just follow it over. Look at this. We went all the way up, came back down. Where do we end up at? We end up all the way right back down at this M15 level of demand. And let's go to the M5, see what we have going on over here. And then take a look at this. We have an M5 that's down here, that previous contrary candle to the push, right? So you would go ahead and mark the top of the wick, put an M5, and then let's follow it over. Look how accurate that is. You can see we came all the way down in that final spot that it really got the rejection from and went back up was that M5, because look at it on the M15. It looks clean on the M15 because we closed right at that M15. We love to see a closure like that, but we went all the way, tapped into that M5, and that's what got that push up. So you can see that's a really clean example of a level of demand. All right, here's another example of a level of supply. So remember, we look for that previous contrary candle to a push down. So we have the previous contrary candle right there, and then the push down. So you would go here, we're on the H1 time frame, so we would go ahead and mark that, put H1, and this is just on one time frame right here, but look how we came all the way back into that level, tapped into it, and then went all the way down. And supply and demand is the strategy. That is the main, most important part. Remember earlier when we talked about multiple time frames in Confluence, we're just going to do another example real quick. Let's say we have this right here, right? Let's say we have a M1, then the other line is a M15, and let's say this one is a H4. This right here, especially if your stop loss was like this, just say, and obviously this is a way bigger stop loss than we would use, but this is just for an example. This is going to be a higher probability setup because you have not one, not two, but 3 levels, 3 opportunities for price to reverse and go back into profit before it would hit your stop loss. Now look at it this way. If we were to delete, just say this one and this one, and we had no levels up there, no levels of supply, then price can go. And of course, it would be nice if it just bounced off this one. But if we broke past it, now we have nothing stopping price. And let's say there's like a level up here, then it's most likely going to head to that level and it's out of your stop loss, so it does not matter for you. So that's why it's always best to have multiple time frames in Confluence so you have the highest probability possible of it not hitting your stop loss. And like I said, I was going to make this more of a shorter video. I went way more in depth with my strategy live with my group and in some other videos. So if you want to get a more in-depth look into my strategy, go ahead, join my group, or just go ahead, message me, or check out any of my other YouTube videos. But to get to the last final thing of this strategy is you can go ahead and use Sonar Lab sessions right here. This is the one I use, and this is going to go ahead and mark out Asian, London, and New York session. And one thing you could do, and some people do this, some people don't, is just marking out the session highs and session lows. You literally just go here. It already marks it out for you. You go here, you put session high, and then you can go all the way down here and you can put session low. Now with this, what you're going to want to do is you're going to want to mark out the highest point and lowest point between London and New York session. It's as simple as that. You don't even need to mark anything in Asian session. It's just the highest and lowest point of London and New York session. If you have a session high or a session low in confluence with multiple time frames of supply and demand, it honestly raises up the probability a little bit. I've noticed a lot of times around those session highs, session lows, the market likes to reverse. And if you have it in confluence, like I just mentioned, with a supply and demand, it just makes it even a little better. So that's the strategy. That's a very simple, not too much in-depth look into it. Like I said, if you guys want to get a more in-depth look into my strategy, go ahead, join my group. You can message me, or you can just watch some of my older videos and I go and talk about it even more. And the video here, guys, if you guys like the video, make sure you leave a like, comment, and subscribe. And I'll see you guys in the next video. Peace out.